Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be revisiting Lululemon stock since the price has collapsed even more since last May when I covered it, which was the last time I covered it here on the channel. As always, this is not individual investing advice. This is just how I analyze stocks. And we're going to be examining Lulu from using a different technique than the last time that I looked at it on the channel, examined it on the channel. During that analysis, I basically used an earnings analysis and projected out earnings growth relative to where the earnings were at the time or expected to be for this year, and then try to work out a pretty basic valuation on where would be a good spot to buy the stock, a good price to buy it with a margin of safety, assuming they could grow earnings about 12% a year for like 10 more years. So those were the assumptions that went into that, and I came out with a buy price of $241 a share. So during this decline, I don't think it actually got, let me double check before I say this. I don't think it actually, oh yeah, it did. Yeah, so it did fall below that price when I wasn't paying attention. But I had, it's not that I wasn't paying attention, it's that I changed kind of how I was going to go about doing this. So, but a person could have bought at 241 if they listened to my last video and they would be up a little bit. But I didn't buy, and I'm going to kind of explain kind of some small adjustments that I made after I kind of dug in and thought about the best way to approach this one, particularly if we might be going into kind of a recession at the same time that there, or even just a weakened economy, a weakened consumer at a time when they kind of need to adapt their offerings to the public. I mean, retail and apparel is a very difficult business. They've been one of the better businesses for the past, 15 or 20 years or so, like 15 years. Publicly traded anyway, so they've been a big winner, but it's hard to maintain that for the long term, and there's definitely bumps in the road, which is kind of what we're starting to see now. So with all that context in mind, I decided to just slightly change how I was approaching this stock. I'm going to be using Fast Graphs to help me with this along with my spreadsheets. I do have a 25% off affiliate link for Fast Graphs down in the description if you want to give it a try. I think they have free trials over there if you've never tried it before. Make sure to use that link and you can get a big discount. I also have Patreon links down there as well. This did originally come in by request. If you have a request for a stock you'd like me to take a look at, just put it down in the comments. I'll get it on the whiteboard behind me. Eventually I'll make a video. Those that are in the S&P 500, like Lululemon, I post on YouTube for free, and the rest I post over on Patreon. I'm also going to be launching a new Patreon tier here soon, so we can keep an eye out for that. But the basic one is only $5 a month. So that'll get you, when you request a stock that's not in the S&P 500, I'll post those only on Patreon. And the full Cyclical Investors Club service on Seeking Alpha. So let's get back into this analysis. So one of the issues that we have here is there's probably, we don't have a real recession data to go look at from 2008. They basically went public right at the beginning, right in the middle of 2009 or so, 2008. So they were kind of right on the edge. We didn't really see what they were like going into it in terms of like earnings and how earnings were affected by the Great Recession. So we don't really have that data to go back to as a reference. Now we can see that this period, when we look at the fast graph from, let's see, let's go to 2017. Really this period from 2013, 14, 15, 16, that kind of period in there, they really didn't have a whole lot of growth. I mean, 3% growth, minus 1%, minus 2%, and then we got a 15%, and then we got tax cuts and a 21%. Actually, tax cuts would have come in the next year after that because their fiscal year starts like in January. A lot of companies are in December, so that would have come in the next year, which was a 48% bump. So that was probably the tax year affected bump. So they did start to pick up growth and popularity, but we can see that they've definitely gone through periods where earnings didn't really grow that much. So, this is like a fashion apparel business. They can just have ebbs and flows along the way. Now, one of the things I'm going to do is go back to that period of weakness because they actually grew really strongly coming out of the Great Recession. And then they kind of leveled off about 2013. So that's a period of weakness. 2012 was kind of an economic period of weakness. And really, they didn't grow earnings for like 3 years, 3 or 4, at least 3. And so I'm going to use this because I don't have a good recession data to look at to try to estimate a little bit what we might expect in like a mild recession or just an economic slowdown combined with maybe a period where we're kind of seeing now where their growth is struggling and it's really more about them maintaining maybe market share than growing. So this is going to be a way to gauge like how far it could potentially fall and what would be a decent price to try to buy it at. The way I do this, I call this the Recession PE ratio, which is something I invented, is you look at the peak earnings, which is $1.91 back here in 2014 during this time of weakness. And then you look at the trough price, which if I go up here, it was like $36, and you can create a PE ratio out of that. On this one, because earnings didn't really fall very much, you can just kind of look at the fast graph and see that the low PE ratio during this time was about 19.77. That's a decent estimate. Now, a lot of stocks during a recession, earnings will fall, which they actually did fall a couple cents during this time over the next couple of years, but it was very gradual for them. But and so that's why you use the peak earnings per share, because that is steady. Like that will basically always be once the peak is established, it's the peak, right? So that gives you kind of a reference point, because when earnings fall off a cliff, everybody will panic and sell, and the PE will just get worse and worse a lot of times because earnings are falling. And even if the stock price is falling, if people are just looking at the short term, then everything just keeps getting worse, until it hits a bottom, but there's not like a signal at the bottom. By using a peak earnings assumption and looking at the past at how far the stock has gone down relative to that, it's not like it's not really magic. It's just to help gauge and keep a person rational. And the idea is that even if these earnings fall 30% next year for a Lulu or something like that, the assumption under it is that they'll come back in a couple years and then we'll be back on some kind of a growth trajectory. Whereas the assumption of the market is usually, depends on how bad they end up being, that they'll fall off a cliff and never return, right? So I just made a video of Dollar General a couple days ago, and we can see that with them. See, earnings peaked a year and a half ago, and now they're falling, and the market's assuming, hey, earnings are going to just keep falling, basically, and never recover. Whereas the underlying assumption with this technique that I'm using here is that earnings will fall, but we're going to assume in a couple years or whatever, even if there's a recession, 2 or 3 years, they'll bounce back, and that's kind of the thought behind all this. So now let's go to more modern times from 2016 or so through today. Now, analysts are still pretty optimistic about Lulu's earnings growth at 10 and 9%. But we don't really know. There's not a lot of evidence necessarily. Like, they're just guessing. If we have a recession, these probably go down. And the stock price is telling you that these analysts are probably not. I mean, maybe they'll be right. If they are, then the stock is probably pretty cheap. But if the economy weakens or the business weakens, they could definitely go negative, right? So that's why we use this recession PE. Now, one caveat that I'm going to say here before we get into the spreadsheet is I'm going to use this $14.05 that they're expected to earn this year as my peak earnings. they could miss these earnings still, so it could be lower. And if they go lower, as long as if they fall below 1277, that's the last year's peak. So that is the lowest peak earnings that I would use for the calculation. But I will adjust this. So this buy price that I'm giving could go lower if they miss earnings over the next like 6 months. And wherever this ends up at the end of the year, wherever earnings per share ends up at the end of the year, will be the reference point. Now, if I wanted to just be more conservative, I could just use 1277. And that's okay too. But I'm not going to do that yet because I have some other things in place that are going to prevent me from hopefully buying too soon on the way down. This stock is, let's see how far it's down. It's down 50% off its high at least. So now let's go into the spreadsheet and I'll show you how I do this. I know this is going to be a little bit confusing because nobody else does this and it can be a little hard to explain sometimes. So I'm not sure I did the best job explaining it this time. So now when I go back to that 2014 era, which is, let me move my face here so I can see so there's the recession one. Okay. So when I go back to that era and I look at the low price and the peak earnings, that PE was 18. I have it 1898. That's a little bit lower than the 1977 that was in Fast Graphs, 18.98. Because this is a pretty high PE, I just leave it at 18.98. If it's a very low PE, sometimes I'll go ahead and multiply it by 20% or 30% if it's down in like the single digits, just because there's more margin of safety there. When you have a higher historical PE, that's historical recession PE, the danger is there's always just multiple compression that can take place if earnings growth slows. Like you remember, earnings were growing really fast into that 2014 time period. They were growing pretty fast into this time period too, but we have like stimulus money and pandemic and stuff to think about. That's probably in that. So sometimes I'll give myself more of a cushion if it's a low PE, but I'm not doing that here. So this is just the straight up 2014-ish recession PE, even though it wasn't a full recession. It was kind of just an area of weakness. And this is what I'll use for my calculation today. And so what I want to know is, using that $14.05 peak earnings per share, which you see right here, how low would the stock price, what price would the stock need to trade at for me to get this recession PE? That's what I'm trying to do here. And that is actually $266.67. Now this is higher than my previous buy price, but the thing that's different is it's actually a little safer because of what I'm going to explain. If earnings do fall off a cliff in the next year or year and a half, and they fall like 20 or 30%, that the method I used in my previous video for the 241 buy price, that will keep going lower and lower and lower as the stock, as the earnings go lower. And if it basically will keep doing that until, the stock price rises again, and then you can miss out on buying it at all because every time earnings go down, the valuation gets worse. So you can get into a situation where you don't end up buying it, and it kind of depends on the timing of when earnings come out and how the market feels about it and all that. But you can get in a situation when earnings fall that you miss out on opportunities because it just always looks bad, right? It always looks worse all the way down. And then it always looks worse when it eventually bottoms and comes back up and you never buy it. So that's the danger that this method is trying to prevent from doing. Now, the catch here is this isn't the only metric that we want to use. I also want to layer in a momentum factor because let's open the fast graph again. We have a situation here where we have pretty good growth going into the pandemic and then explodes with one, people, I guess, working out at home in their Lululemon instead of wearing their suits to work or whatever. But we also had a lot of stimulus money, so more people could afford expensive Lululemon clothes, which, as far as I can tell, are pretty expensive. My daughter tells me they're expensive. So I think that this really could be like a boom period, and we should probably expect some kind of a bust period coming up if we have a weak economy. So what that could mean is these earnings expectations that analysts have end up being like completely wrong. They could be, instead of earning $15 in January 2026, next year basically, they could earn $10 or $9, right? And that's what having a momentum factor along with a basic price that we're looking at can help with. Now, for momentum, since I have my business over on Seeking Alpha, or one of them, I use their momentum score here. So they have a momentum score. So if you're a premium member over on Seeking Alpha, you can look at their momentum score. I think it's a pretty useful tool. But you don't have to have that. You can use like a 200-day moving average, which you can find on any brokerage. If you have a brokerage account, you can look up the 200-day simple moving average. And that'll get you pretty close. Now, you might not want to do it to the penny. You might want to make sure it kind of holds it for a week or so and it's not just spiking up and then immediately dropping. But you want to get this price, 266, and positive momentum above like the 200-day 50 moving average or whatever momentum metric that a person finds useful. But I think the longer and more stretched out they are, rather than like a 50-day, they can jump up and down a lot. The longer that, really what we want to see is we want the stock price to dip below this 266, which it actually already is, which is why I'm making this video. Probably dip quite a bit lower, form a bottom, and then start to come out. And when it starts to come out, that's when to come in, because there's a lot. We don't have real recession data. So how reliable this recession metric I'm using is definitely questionable. Two, we're coming off a bit of a boom, which could make the downturn worse than even a normal recession if we do have a recession. I'm talking about the earnings here, like future earnings. Two, retail apparel is a very difficult business, and it's just really, really hard to keep these growing at a steady rate for a long time. So in the back of my mind, I really want some kind of bottom, and you never know if it's perfect, but you want to pay a cheap enough price, and you really want, I think, the momentum to be moving pretty solidly in the recovery. Now, you're not going to pick the bottom when you use this method, but it helps you from getting killed, which I think I made my last video in May, like right around here. So since then, the stock price is down like probably close to 30%, it looks like. So, and nothing really changed too much fundamentally. The market just decided it didn't like it. So I realize this is kind of a complicated approach in some ways. Like, to explain it's kind of hard, but it's actually pretty simple. You want to buy it at a relatively cheap price compared to previous weak periods, right? Like 2014 back here. I don't know how far the stock price actually fell. Stock price fell 50% back then, right? So it's fallen the same amount that it fell already this time. So it wasn't a super weak downturn for the stock. That's a significant drop. So that was kind of the model here, but it could definitely fall more. So really what we're saying is, look, we want it at least there, which we're kind of at right now, right? And then we want it to form some kind of bottom, the stock price, and to start coming out to give us a sign that, look, we're probably, we formed a new bottom wherever that is, and maybe they can get growth going again, either because the wider economy improved or because they made adjustments in their business or whatever it is. But this is the type of setup where I think you really want to have some evidence that things are kind of coming out. And you can't really wait for earnings. It's like, well, why not wait for the fundamental? Well, if you wait for the fundamentals, the stock price will already rise ahead of time. You're not, by the time the fundamentals really come in and it's all clear, the stock price will be up 100% off the bottom. So that's where I don't use momentum too much, honestly, but this is the situation. I use this for cyclical sometimes too, when it's extra kind of risky and figuring out the bottom is a little bit trickier. Just layering that in and making sure you're down low enough first, and then they're starting to recover. And even if it doesn't work out, usually your losses are far less than when you're really trying to catch a falling knife, which is what investors have been doing the past year. All right, if you found this useful, hit the subscribe button, hit the like button, drop a comment if you have a stock you'd like me to take a look at. I've had a lot of requests now that the market's getting a little choppy, so I'm going to try to put a video out almost every day. Thanks for watching. I'll see everybody later.